Hello everyone, welcome to my channel. Today we're gonna go over this full response question. It's kind of long, but it involves every details and concepts and the possible types of questions that you'll be asked in the AP test. So this is a really good question for you either to review or studying or prepare for your next test. And so for this full response, it basically includes ADAS model and then the money market, like you have to be able to draw it, and then the spending multiplier, how to calculate it, how to use it, and the exchange rate markets. So, as the foreign exchange market, sorry, but we have to use the exchange rate to do questions. Okay, so let's start it. I'll read the questions for you, and as I'm reading this, I will just draw the questions and explain it to you. So, first, it says Canada is an open economy that is currently in a recessionary output gap. And for number A, it says draw a correctly labeled graph of the long-run aggregate supply, short-run aggregate supply, and aggregate demand curves, and then show each of the following. So number 1, the current equilibrium real output and price level, labeled as Y1 and PL1, respectively. And then number 2 is the full employment output, labeled YF. Okay, so this is just a very typical ADAS model question. So we can just starting by drawing the graph. I don't know if you can see it. Okay. So remember for ADS model, this is price level and this is real GDP. And this is the aggregate demand. And this is the short run aggregate supply. And then it says it's in the recessionary output gap, which means the potential output. So right here, it says labeled to YF, it's gonna be like greater than our current output because we didn't reach that level yet, right? We are right here for Y1, and this is our PL1, our current price level, and this is the long run aggregate supply. Okay, and so yeah, so this is the first graph, and if you can you can draw this, then you get the first whole questions, like all the points you get it. Okay, so that's not hard, right? So let's move on to number B. So the central bank and the government do not take any policy actions to close the output gap. Explain how the economy will adjust itself to full employment in the long run. On your graph in part A, show how the economy adjusts to full employment in the long run. Okay, so for this one, remember that, so for this one, it didn't like ask you to use any of the policies, like either the monetary policy or fiscal policy. It means that government and the Fed didn't take any reactions at all. Like, so it's just like a self-adjustment in the long run. So remember, any of in the long run, any of the short-run aggregate supply will shift out, to shift to the right and go back to the equilibrium. So which means it will shift out. So this is the new short-run aggregate supply curve. So, and it also asks us to explain it. So what you can say is that because right here we are in a recessionary gap. So at this point, the whole economy is bad. Like we don't have that enough monies, and the companies don't need that much of workers. So people demand lower wages because of the bad economy, and which means the resource cost for the companies will decrease. And this is gonna shift the short aggregate supply to the right, because now they can take less resources to produce the same amount of products. So then they would like to produce more compared to before. Okay, so let's move on to question C. Suppose the Canadian government is unwilling to wait for the long-run adjustments process. Oh, wait a second. So let me just write it really quick for the part B. It says to explain, so you can just say people demand lower wages because bad economy. Yeah, so if it asks you to explain, just make sure you write it like in a whole sentence, or you can show the chains, like which one causes which. That will be also, that is also fine. Just let the judges, like for your AP test, let them know that what you're thinking, what your logical is. So just write something similar to this, then you'll get the point. Okay, so let's move on to part C. Suppose the Canadian government is unwilling to wait for the long-run adjustment process. The marginal propensity to consume is 0.08. The equilibrium real output is $500 billion, and the full employment output is $540 billion. So calculate the minimum change and indicate the direction of changing government spending required to shift the aggregate demand curve by the amount of output gap. Okay, so for the first, CI, it says for the, so it tells you the, right here, we're at here, right, Y1. So it says Y1 is $500 billion. And YF, so this is the point that we want to get into finally. So this is $540 billion. So which means that this gap is $40 billion. And this is the amount of money that the whole system needs to recover the recessionary gap. And what the government can do, well, in this, right here, you have to use the spending multiplier. So just remember the spending multiplier is equal to 1 over marginal propensity to save. Okay, so, but the good thing is that they tell you the marginal propensity to consume is 0.8. So then this is the marginal propensity to consume. So in order to get the marginal propensity to save, you have to use 1 minus 0.8, okay? And then you will get 0.02. And then you will use to calculate the spending multiplier, which is 1 over 0.02, and then times x. I usually use x just for simplicity because it's kind of more visualized for me to know to deal with these equations. And then the amount that we have to cover is 40, so then set it equal to 40, and then this we can just simplify it to 5. So divide both sides by 5, we can get x is equal to 8. Okay, and so this, we can figure out this is the amount of money that the government have to increase spending. So it will shift the aggregate demand to the right and ultimately recover the recessionary gap. Okay, so let's move on to C part 2. Calculate the minimum change and indicate the direction of changing taxes required to shift the aggregate demand curve by the amount of the output gap. Okay, so this is required for the tax multiplier. So remember, tax multiplier is going to be equal to negative marginal propensity to consume divided by marginal propensity to save. And another quick memorizing tips for you is just so remember, tax multiplier is always 1 less than the spending multiplier. So if we figure out that the spending multiplier is 5, then tax multiplier we can just set it. We can just know that's 4. And the negative sign. So negative sign. So I think different teachers maybe have different requirements for that. But the negative sign right here just indicate that either you're gonna increase or decrease the tax. So so after we get this is the tax multiplier. We just use for x equal to 40. Remember, this is the same amount that we have to recover right here. So x is gonna be $10 billion. And then remember, this is a negative here, so the taxes have to be decreased by $10 billion. And this is the increase spending and actually government spending by $8 billion. Okay, so these are all of the A, B, C part. So just remember all of this, how do they relate it, how each one affected to each other. And then let's move on to part D. Let me just clear the board a little bit so we have more space. Okay, so for part D, It says, assume instead the Canadian Central Bank takes actions to restore the economy to full employment output by influencing investment spending. Draw a correctly labeled graph of the money market and show the effects of the actions taken by the central bank on the equilibrium interest. Okay, so right here we're moving into the money market graph. So remember, I mentioned to you before, this is a really important graph that you have to remember and be able to draw it in every of your tests, and especially AP tests. Okay, so remember how to draw the money market graph is, so the y-axis is nominal interest rate, and the y-axis is just quantity of money. And money demand always downward sloping, remember. Money supply, however, is different. This is a vertical line for money supply. And so the reason for this, you can think about because the money supply is set by the Fed, so the Federal Reserve set it, so it's just a vertical line. Like the Fed can decide what he wants and their ultimate decision. Okay, so then remember that if you are in a recessionary gap, then the Fed is going to increase the money supply in order to recover the recession. Right? Because right now, there's not so many monies flowing in the system. So then in order to recover that, we have to shift the money supply outward. Okay. So then this is the before the nominal interest rate, and then right here we have a new nominal interest rate. So we can see that this is decreasing and the quantity of money is increasing. Okay. And then it asks us for the equilibrium interest rate. Okay, so in here we have to think about it something. There's a really important formula, which is how do you find out the real interest rate? Remember the real interest rate, the relationship between it and the nominal interest rate is that real interest rate is equal to nominal interest rate minus inflation. And how do you get the inflation? Well, looking at the ADS model, the price levels. Price levels is often used to figure out the inflation. Okay, so we have to draw a new ADS model graph for this. This is the price level, real GDP. This is AD, and this is short-run AS. And so the long-run AS is not used for this question, so I'm not going to draw it just for simplicity. And remember, so how is this graph shift this graph? Which curve does it shift? Well, it have to be a aggregate demand curve. Why? Because if you shift the money supply curve, then on the ADS model, there's lower interest rates. Okay, so lower interest rate means what? Lower interest rates means more investment and more consumptions. Okay, and remember these two are the factors to shift the AD, and AD is C plus I plus G plus NX, which stands for consumption, investment, government spending, and net export. So yeah, so thinking about the logic a little bit in here. So if you decrease the interest rate, which means that for the investment, if the interest rate right now is very low, then it's not worth it to save your money into the bank because you get lower return. And instead, you're better to do the investment in here. And also the same thing applies to consumptions. If it's real interest rate is very low right now, and then it's better to just consume your money into the system, into the economy system, instead of just saving in the bank because you get lower returns. So, which means that AD is going to shift to the right in here. And we can see that this is our new price level, this is our new real output. They both increased. Okay, so then use this formula, back to this formula again. According to the money market graph, we can see that nominal interest rate is decreasing. And, no, I'm sorry, nominal interest rate should be here. So this is decreasing. And the inflation price level is increasing, which means that inflation is increasing. So this is increasing. And thinking about a little bit logic in here, if you use a smaller number minus a higher number, then the result will be what? It must be decreasing. So the real interest rate compared to before, it has to be lower. Okay, so yeah, so this is the part D, and then last part E. Let me just clear this out a little bit. Okay, part E. Part E, it says Canada and Mexico are trading partners. Draw a correctly labeled graph of the foreign exchange market. Okay, keywords in here, of the Canadian dollars, and show the effect of the change in the interest rate in part D on the value of the Canadian dollar with respect to the Mexican peso. Okay, so think about that. So whenever which currency it asks you to draw, like you just imagine that currency as a product. So being able to thinking about that, you will not be surprised if we like draw the same relationship with ADAS model. Like, okay, so let me just draw for you really quick. So this is, remember, this is for the Canadian dollars foreign exchange market. So on the y-axis, whenever like the currency that you're using, imagine that as a product. So you have to use another country's currency to measure the value of it. And in here is the pesos, right? So remember the peso, put it in front, and then in the denominator put it the Canadian dollars. Okay, so and also the x-axis is just the quantity of Canadian dollars, because we are graphing using like the pesos to measure the Canadian dollars, and the Canadian dollars is right here, our product. Okay, and so just draw like normal demand and supply curve in here. Really not that hard, but it says, so according to our previous part, we figured that out that the real interest rate is decreasing right now. Okay, so thinking about it a little bit. So if a country's real interest rate is decreasing, which means that if the investors go into that country, they will get lower returns, right? So every investor don't want to like get lower returns. They want to seek higher returns, which means that the amount of investors go into Canada is going to drop. So if there's a less amount of people go into Canada, they will need less amount of the Canada dollars. Okay, so which means that the demand for the Canada dollars is going to go decrease. And you can also think about like the supply of the Canada dollars is going to increase, because compared to the Mexico right here, the Canada have like their currency values is dropped, and then the currency value for the Mexico, like the pesos, is increasing. So the Canadian dollars is depreciated, and the pesos are appreciated. So then more people would like to change their currencies from Canadian dollars to pesos, which means that the demand for pesos is going to increasing. And in order to exchange more of the pesos, you have to use more of the Canadian dollars to do that, which means that the supply of the Canadian dollars is going to shift to the right. So for this question, like either shift is okay. So you can either like shift the supply to the right, or you can shift the demand to the left. Okay, so they're both logical correct. So in here, I'm just gonna use like the supply to shift to the right for the Canadian dollars. And then just in case, let me draw another graph. So this is also correct if you draw this, which is the demand is going to shift inward, and just the normal supply. Okay, and then just showing that how it change. So in here it's going to decrease, and in here it's also going to decrease. So in here the quantity doesn't matter. Like even though like these two graphs, like they have different amount of like the shiftings in quantities, but we don't have to care. Like we just cared about the y-axis, which is the currency exchange rate for like the two currencies in here. So in both graphs you can see that they're both decreasing values. So which means that the values of Canadian dollar with respect to the Mexico peso is going to be depreciated. So the Canadian dollar is going to depreciate. And you can also write peso is going to appreciate. Okay, so this is our conclusion for this question. And if you want to like write the logical chain in here, let me just clear out some more space. So if you want to like write the logical, like, it didn't ask you to explain it, but if you want, you can say in here, like the real interest rate is going to decrease, which means more investors, is going to go to other countries. And in this case, it just means like Mexico. Don't have to think about too complex in here. To seek higher returns, which means that the demand for Canadian dollars is going to decrease. Or you can say that supply for Canadian dollars is going to increase because we have to exchange from Canadian dollars to other countries' currencies, which in this case is peso. So, which means that you can just say it directly leads to here. So this is our final answer. Okay, so all done. So again, so this question, this response is kind of long compared relatively, but this covers like a lot of graphs in the macroeconomies, and it's very useful for your especially preparing for an AP test or like other tests. But this includes a lot like the almost all of the unit like key graphs in here. So be sure to figure out these problems. Will definitely help you to do all of the other similar questions. Okay, so if you're like confused about either part, just go back to that part in this video and re-watch it again. And if you have any questions, please comment below. I'm happy to answer it. And if you like my video, please subscribe and leave some comments below. I'm really happy to hear your thoughts. Okay, so have a nice day. See you next time.